Hi guys, welcome to another week. This week we are looking at budgeting. Okay, budgeting is really important. It is an accounting concept. It does affect so many people in the workplace. You know, you might be responsible for a particular activity in your workplace, and you might be given a budget. So you might be given a budget such as how many units you have to produce and what amount of money you've got to spend in producing those units. So you've got a budget in terms of how much you can spend, or you might be a salesperson and you've been given a budget with the expectation here is how much revenue you're going to generate for the firm. But it just seems as though just about every job that people have, okay, every job that people have, people will be involved in budgeting. Okay, it seems as though it's a very common function. Okay, it's so that we can keep control. We can't just say to someone, oh, you're producing widgets, we want you to produce 500 and spend as much as you want. Well, that's not really going to work. Or you're producing widgets, just produce as many as you want, we don't care, just go ahead. Okay, well, that wouldn't make sense because the firm would soon go broke, because probably revenues would be lower than they wanted and costs would be out of control because people would just spend. Sometimes you might have a situation where you've got a government department or a sports agency where they've only got a certain amount of money that's been given to them by the government, and that's all they have to spend. So they've got to stick to the budget or they'll run out of money. Okay. So let me get started. Okay, let me get started. So, of course, we'll, like we always do, we will share our screen. Okay, and we'll go from there. So let's have a look. We can share our screen like that. And so today we're looking at budgeting and variance analysis. Okay. And as part of that, we say that budgeting is an accounting function, but like I said earlier, it really does affect lots of different people within the organization. Okay. Not just the accountants, but a whole group of people, because everyone seems to be involved and affected by budgets. So let's have a look. Some of the basics. So let's start with revenue. If your revenue is greater than you budgeted, so you've got more revenue coming in than you expected, we say that's favorable. If your revenue was less than expected, we say that's unfavorable. Now, that could have been your cause because you didn't sell enough and that was your role, or it could have been caused by a wider situation, such as we've had with COVID-19, where basically a lot of firms aren't buying. And so there's been a massive downturn in our economy. Okay, so that's one thing. On alternative, we have expenses. If our costs are greater than what we budgeted, we've spent too much than we expected, that's unfavorable. However, if the costs are less than we expected, we like to say that is favorable. Okay, we haven't spent as much as we need. Now, normally we'd see that as a good thing, but it could be a bad thing if it means that our costs are lower, but we haven't maintained our equipment, or we've used inferior quality products in the production process. That can actually be a bad thing. So it's not always as clear cut as you might expect. Normally we take the variance and we divide it by the budget figure and times it by 100, and that gives us a percentage. Okay, it's often more relevant than dollar figures because it really, you're trying to look at the variance relative to how much the budget was. Because if you're looking at, if you're $1 million over $1 billion budget, that may not be very much. But if you're $1,000 over a $2,000 budget, that's really bad because that's a 50% variance. Okay, so sometimes if you just look at numbers for themselves, it doesn't tell you a whole lot. Okay, So let's have a look at this example. Let's have a look at an example from a fundraising evening for maybe a sports club. So they expected to sell 400 tickets, and the price of each ticket was going to be $100. The variable costs were $25 per meal, and the fixed costs, say the venue and the band hire, were $15,000. But what actually happened on the night? Well, they had 450 people turn up, but they found out they were only able to charge $80, maybe because it was just $100 was too expensive for what they were offering. Meal and other variable costs were $13,500. Okay, so meals, drinks, whatever that could be, and the venue and the band hire. Okay, so let's have a look how we went relative to our budget. So the first one is revenue. We expected to have 400 tickets at $100 each. So that would have been 400,000. But we only ended up selling $36,000 worth. So that's an unfavorable variance of $4,000. The variable costs, we expected them to be 10,000, but in the previous page, we said they're actually 13,500. How did I get 10,000? Well, that's 400 tickets times $25 a ticket. And then the fixed costs, we expected them to be 15,000. They were only 14,000. Okay, so we were $1,000 favorable. That figure there, sorry, I made a mistake, should be 15,000. So some are favorable, some were unfavorable. And so if we were looking at the analysis of the wash up of the evening, we might start saying, well, the meals and variable costs per ticket, how much was that? Was it more than we expected? If it was, why was it more? It's good to see that we got maybe a better deal for the band. They might have played a bit cheaper, or maybe the venue gave us a discount because we had so many people turning up. There's a number of different reasons why that may be the case. Okay. Now, an examination of basic variances calculated shows that the function resulted in unfavorable variances for revenue and variable costs. Okay. Calculation of the variances as a percentage shows that while the dollar values were similar, it is the variable costs that are the main concern. They were significantly different. We said about 35%. So what we're saying here, so I'll go back again. See how that's $4,000 and that's $3,500. The percentage is so important because 4,000 of 40,000 is about a 10% variance. And a lot of people would say, you know what, if you're organizing a function, you normally have about a 10% variance perhaps. But this one was 35%. So if you were analyzing where things went wrong, you would really focus in on that figure there because it was so wrong. Okay. Now, this brings us to budgets. Okay. Now, there's two main types of budgets. There's what we can call static budgets, and that's just a single set of budgeted figures that hopefully last us maybe the whole year. They're prepared and we use them for analysis. But you know what? Often static budgets become kind of out of date pretty quickly. So if we were looking at what's happening in our economy at the moment, we would say that our budgets are pretty out of date, okay? Because so much has happened in the economy with so many businesses struggling. A budget that we prepared last July would have no relevance to today, okay? A flexible budget may be more useful, okay? the original budget is modified to reflect a different activity level. Okay, so you might have a situation where you're looking at expenses, okay, and you expect to produce 10,000 widgets this year. Now, you might say to the person who produces them, you say, well, you're producing 10,000, your budget is $100,000, okay? But what happens if he produces 20,000 widgets because they've had a really good year? You can't expect him to have the same expense budget as he had. No, it should go up because he's producing more goods, and that would be reflected in a flexible budget, okay? Now, there's a few other things we can talk about, okay? Price variances. That's where the flexible budget minus the original budget. Volume variances is actual minus the flexible budget, okay? So let's have a look, okay? So the actual for this company was 36, so this is our example we were looking at. Our revenue was 36,000. Our variable costs were 13,500. Our fixed costs were 14,000. And we had a small net surplus of 8,500. Now, instead of having 400 people at this event, we had 450. Now, if we adjusted our volumes for that number, okay, we would say, well, actually, let's skip this. The original budget was 400 people at $100 each, 400 people at $25 a head for the variable costs, and $15,000 worth of fixed costs. If we had a flexible budget, we would say, well, 100 people at 450 people at $100 is going to be $45,000, okay? 450 people at $25, 11,250. That's our fixed costs we expected, 15,000. Now, if we had have maintained what we expected based on, instead of 400 people, we had achieved what we set out to based on 450 people, we should have expected a surplus of 18,750. So when you take everything into account, the fact that we had 450, we should have had a larger budgeted surplus, but in fact it was significantly less, okay? Significantly less. And we'd ask ourselves questions like, why did the ticket sell for 80 and not 100? Why were the variable costs per person greater than $25? And why did our fixed costs fall like that? But that's a good thing, right? The fixed costs. So when we have a look here, okay, based on some budgets, we can come up with a few things, okay? So 36, the difference between 36 and 45, so the flexible budget and the actual is $9,000. The difference between the 13,500 and 11,250 is 2,250. And then we can look at the fixed costs, okay? If we go look at volume variance, okay, that's a little bit trickier, okay? That's going to be the difference between the flexible budget and the budget, okay, as is this one here, and there was no difference there. They're just different ways at looking at our numbers to try to work out where are we going wrong, okay? So although the variance for revenue is unfavorable, okay, we can probably say that the real issue was the price charged for the ticket rather than the number of people who bought tickets. That's a good thing, more people buying tickets, okay? Similarly, it may be seen that although there was expected to be an increase in total variable costs due to the larger number of sales, okay, the variable costs still should have been lower than what was incurred. Okay, so the whole idea about budget analysis, we want to know where things go wrong. And the reason we want to know where things go wrong is that we can look at it and make it better for next time. We can look at it and say, well, where did we get this idea that we were going to sell tickets for 100? Where did that go wrong? Maybe next time, if we know that people are only going to pay 80, we've got to go to a cheaper venue, and maybe our variable cost might be $17.50 instead of, what was it, close to 30. Okay, we can change the way we do things. Okay. So any of this budgeting requires accurate identification of fixed and variable costs. Sometimes they can get a little bit mixed up. It can explain what went well and what went badly within the period. Okay, and it may even mean that we have better budgeting in the future. Okay. Now, in order to apply flexible budgeting techniques, it's really important that we can understand what a fixed cost is and what a variable cost is. Okay. And some costs have a bit of a combination of both. Okay. So a fixed cost is a cost that remains constant regardless of the level of output. So I might own a factory and I might rent my premises. I might rent my building. Doesn't matter whether I pay it doesn't matter whether I make one widget or I make 1 million widgets, my rent is going to stay the same, okay? A variable cost, on the other hand, I might be a baker, okay? And the more loaves of bread I bake, the more flour I use. So as my output goes up, my total variable costs go up, because it tends to be the more I produce, the more costs that I incur. Now, some things have a bit of a mixture of fixed and variable costs. Now, if we think about an example, there's many examples. Some phone contracts, for example, you might have a situation where you pay a monthly fee to the phone company, might be $50, and then you pay for the calls that you incur. So the monthly fee might be the fixed component, might be $50 a month, and the core component might be the variable amount that changes over time. Now, so more detailed management accounting systems involve identifying cost drivers, so what causes costs to be incurred, and analyzing them. We want to know what causes the cost, because you can really only solve the problem, okay, if you can identify the costs. So let's have a look here. Mark's personal training studio has incurred the following electricity costs over the last 3 years. So they conducted 3,000 sessions, and it was $10,000. 3,400 sessions, and it was $10,800 in 2010. In 2011, they conducted 3,100 sessions, and the electricity cost was $10,200. Well, with this, we can do a little bit of analysis, and we can understand our costs a little bit better, okay? And the way we do this is what we call the high-low method. So we take the highest level of activity and the lowest level activity. We're able to determine how electricity costs vary, okay? So 10,800 minus 10,200, they were my electricity costs. The difference there is $600, and 3,400 training sessions minus 3,100 training sessions is 300. So it seems that electricity is $2 per training session, okay, that they run. So with this in mind, we can use this information to determine what our fixed costs are. because our fixed costs are going to be the total costs less the variable. Now, we said in 2009, total costs were $10,000 and they conducted 3,000 sessions. And we said the variable cost per session was $2. So 10,000 minus 3,000 times 2, 10,000 minus 6,000 is 4,000. 2010, do the same calculation, we come up with the same answer. So either way, it tells us that our fixed costs are $4,000. We probably can't do much about the fixed cost, but can we reduce the variable costs? Or maybe we can. Maybe we do more sessions outside in the park as opposed to inside where we use electricity. That might be one. Or maybe we try to use more natural light and turn off the lights. Or maybe we go really extreme and think about solar or something like that. So if Mark budgeted for 3,800 sessions to be conducted during 2012, it's going to be the fixed cost of 4,000 plus 3,800 times 2. We expect a cost of 11,600, okay? 11,600. So that brings us to the end of our lecture. Another interesting topic, really an important topic in the big scheme of things when we're trying to learn how to budget and those sort of things and understand what budgets are all about. In the accounting world, we often call them people who kind of manage the budgeting process. We call them management accountants, but at the end of the day, everyone has to take responsibility for their budgets, okay? Because it belongs to them. It doesn't really belong to the accountant. You know, if you've got a sales budget because you're the salesperson, it's your budget. It's not really the accountant's budget, or if you've got an expense budget. So thanks very much, guys. Make sure you attempt the tutorial questions, and I will speak to you next time. Have a great day. Bye.